I'm going to turn on a light so it's not quite so dark on my side. Hang on.
Okay.
Well, good morning, guys. How we doing?
Good. How are you, Rick?
Wow.
Good.
I am good. Well, Jessica, it's nice to see your smiling face this morning at dark 30 for you.
Kind of. Although it's funny because this used to not be quite so early for me, but given sleeping habits during quarantine, it's turned into earlier than I usually get up. Well, actually, right about the time I get up. Earlier than I usually start calls. How about that?
Yeah.
You know, I think that's pretty much the case for all of us.
Yeah.
And, you know, some of you know that I'm usually a pretty early riser. Some of you have had early morning classes with me for years. I would target being in my office by 6:30 or 7 in the morning to start my day. And I'm doing good to roll out of bed by 7 o'clock at this point. So it's things are a little bit different. Griffin, you shaved again, brother.
I did.
You did. So is this like once every 4 or 5 months? Is that the pattern we're in now? Is that where we're at?
Something like that. Yeah, something like that.
Well, look, Jessica, I appreciate you being with us this morning, and we have a normal work session put together for some of the dive we're doing into this material today. But since you were good enough to send us some information, I was hoping you would spend a few minutes speaking with us about how you see the Jobs Act specifically, and maybe other pieces of legislation and regulation more generally having affected the private issuance marketplace for equity and debt. And then if you'd like to also make some comments with respect to its counter effect on the public markets, that could be interesting as well. So you should know that I believe it's Jaden who is responsible for the regulations part of this project. And then Griffin is working on the, I think, rates of return, right, Griffin?
Correct.
And then Britton is working on availability of capital. And so the three of them are kind of taking individual elements of what we think are some of the more impactful parts of the changes that we've seen in the public and private market balances. So with that, do a brief introduction, as if you would, unless you already have, about what your role is, and then we can understand the context from which you're then going to talk to us about these issues.
Sure. So no, I hadn't done any kind of information. I think we just really only exchanged pleasantries before you came on.
Well, I know these guys, and they're not all that pleasant, so that must have been smart.
Oh, that's tough for first thing in the morning.
Nah, they're used to
an early afternoon, but
yes, they know my routine.
Sorry, dealing with a little bit of something on the side, but
okay.
So I'm an attorney, and I have worked in the corporate and securities field since I started practicing. I work with a small firm, a boutique firm here in San Diego, and we specialize in securities practice, and specifically representing small and micro-cap companies. So public companies, but on the much smaller end of the public company scale, which means that in addition to periodic reporting to the SEC of financials and other events that may come up, I also deal with capital market transactions quite a bit. These are small companies that are very often accessing the capital markets, and I would say public markets because they are public companies. Often you maybe not generating revenue, or maybe just very small amounts of revenue, but certainly their cost of operation outweighs any revenue they bring in. I mean, I'm generalizing. I have a few clients who that isn't the case, but for those that are accessing the public markets on a regular basis, that is the case. For example, I've got a couple of biotech clients who are in the middle of drug development programs that show promise, but they do not have any product that generates revenue. So their only source of capital to come into the company and fund operations is either through some of these capital market transactions, or sometimes grants, government grants, or some other, they will even do some kind of partnership deals. But by and large, their working capital comes from financings where we tap the public markets. So I actually have quite a bit of experience dealing with transactions that touch on some of the regulatory changes we saw as a result of the Jobs Act, which are the focus of the articles I sent to you guys. Because when I thought about legislation that has impacted how companies raise money, that's the first thing that came to mind. That was a huge piece of legislation that had at its central focus, at least with respect to capital markets, a goal of easing a company's access to markets. And it did so through a number of ways. I would say now that we're sitting here, 7-8 years post Jobs Act, some have been more successful than others. But that was kind of the central goal. I think one of the measures from the Jobs Act that wasn't quite as successful as I think maybe some had hoped was this concept of crowdfunding, what the SEC ultimately promulgated as Regulation CF, which when it was pitched and talked about was meant to be almost like a Kickstarter for capital raising, for a company to go out there and have an easy and somewhat of a direct path to raise money. It wasn't necessarily intended for public companies. In fact, it explicitly was not intended for public companies. But for a small company who maybe didn't have resources to put together full reports required by the SEC to raise capital in more of a traditional sense, was supposed to be a pretty straightforward pathway. I believe the limit on Regulation CF was something like $1 million. So it wasn't, huge capacity. The unfortunate part of Regulation CF was that I don't know that there was enough investor interest to go on to that kind of platform without more expansive information about the companies. And that's one thing that a common theme I've seen as there have been some of these measures to ease access to capital, is this push and pull between easing restrictions or easing expectations or requirements of companies to provide information, because sometimes the information required in, let's just say, a full IPO filing is far more burdensome or expensive for a company to put together unless they're at that point where they're ready to have audited annual financial statements, expend the resources on accountants and attorneys and those things. So that's on the one hand. On the other hand, there's this expectation almost on the investor side that they want or need more information. They want to see audited financial statements. And so it's that kind of back and forth that I think is frustrating for private companies who aren't used to providing that level of disclosure about their operations, about their financial statements, yet they want to tap some of these markets, VC funding, maybe angel investors, but they have not gone through the process of putting that information together. I know for a private company, even the process of putting together a private placement memorandum, which is what's required to access VC-like money, if you're not already a public company, can be pretty burdensome. So it's an interesting dynamic where we've seen regulatory action intended to create an easier pathway for a company, but it's not going to happen unless you've got the investor interest on the other side willing to put up the cash, and investors want to see information. So I do feel like that's a pretty common theme throughout some of these measures. The second biggest regulatory change promulgated by the Jobs Act, and one I deal with frequently, is the ability to engage in general solicitation under what we call Rule 506 offerings or Regulation D offerings. So Regulation D is a set of rules that was, gosh, I wish I could now remember the date it was promulgated, but regulations put in place by the SEC under the Securities Act of 1933. And essentially what Regulation D is I'll take a step back. When you think about the legalities of capital raising and the legality of the process whereby a company sells securities, whether it's equity, whether it's debt, any kind of securities, and an investor pays money for those securities and makes an investment in the company. Securities Law 101 says, I mean, at the very, very basic level, that transaction either needs to be registered with the SEC or be exempt from registration. Whenever we're talking about registering securities or the issuance of securities, you have to fall into one of those two buckets. So what Regulation D is it's a subset of rules that provide for exemptions from that regulation or that registration requirement. And Rule 506 is the rule within Regulation D that's relied on the most. It does not have a cap on the amount of money that can be raised. It has a limit on the number of unaccredited investors that can be involved in the transaction. And have you guys touched on this have you heard of accredited investor status? Is that something that's familiar to you?
Certainly me.
I figured. So what just briefly on accredited investor, it's essentially a standard by which an investor is able, or according to the regulation, if you meet this criteria, you are deemed to have enough information or enough net worth to be able to take a risk by investing in a transaction that's exempt from registration. That may not have all of the information surrounding it. You may not be pitched by a full set of investment bankers and have the ability to ask numerous questions or meet with management. And it's really about the investor's perceived appetite for risk. And it's difficult to assess that on a global basis, but for net worth. And essentially what the accredited investor standard says is if you have this level of net worth, and I wish I could remember what it was off the top of my head. I believe I'll have to pull it up.
I believe right now it's $1 million in net worth. Or
that's what I thought. I started to say that, and then I thought, no, that can't be right. But I'm glad you're backing me up.
Yeah, and I think or you could have $200,000 of income in your previous 2 years. I believe that's it.
And I think that's the relaxation is just taking it to the income level without requiring that the $1 million be liquid capital.
Well, that was in effect before the Jobs Act. That was. And there's also another measure for households where you have 2 income earners. But the bottom line is it's based on net worth, and the thought is if you meet these thresholds, you're considered sophisticated enough. It's expected that you'd have enough experience with investments and that you have the value behind you to be able to bear the risk of losing the investment you're about to make. Prior to the Jobs Act, you could engage in these Rule 506 offerings. But there were very strict requirements around advertising. You could not engage in any level of general advertising, or what we call general solicitation. It had to be, a very tight-knit group of potential investors you were talking to, very carefully following communication standards so that you didn't trip up and engage in any kind of communication that would be considered general solicitation. Following the Jobs Act, it created a pathway, and the SEC implementing rules in response to the Jobs Act, created a pathway where you could do a Rule 506 offering. So you wouldn't have to go through the paces and all of the process and expense of doing a registered offering, but you were able to maybe send out a series of emails to potential investors. Maybe you could even go so far as to maybe place an ad in some kind of very particular journal. And I'm being a little bit vague because there's a lot of technicalities around it, and including having to supply and submit the advertising material you use to the SEC for review. But it did relax those standards in an attempt to reach more people, reach more investors during your marketing period related to the offering than you would have otherwise. And I can tell you that's used all of the time. I think when I think about a transaction flow for a Rule 506 offering, some offerings come out of the gate expecting to do general solicitation, some more broad marketing efforts. Some don't expect to, but then utilize that later on. It just kind of is a reflection of just how well, or in some instances not well, the marketing effort has gone. So I see that one used all of the time.
Quick question, Jessica. Yeah. For that, I know in all the articles I read, it was relatively close to the Jobs Act, and there was an idea that in order to do this general solicitation, the SEC was going to define that how the company had to take at least some reasonable measures to ensure that the investors being targeted were accredited investors.
Right.
How has the SEC required that since then?
Well, in that realm, the SEC, I think of two things. The SEC always has the ability, in connection with these offerings, to request information. And sometimes they single out offerings and ask to see the advertising material, ask questions about the outreach. What measures did you take to ensure you were only reaching accredited investors? How did you ensure you were not, reaching somebody who would not or should not be involved in your offering? And that may be just looking at that outreach list. And how do you know everybody on this list was accredited? Did you or your banking firm have an existing relationship? Did you ask for some kind of questionnaire to be filled out? Did you, it's interesting because, and then this was actually one of the criticisms of that aspect of permitting general solicitation was from the company side, okay, you want us to make sure we're only talking to accredited investors. And I'm speaking very generally. I mean, like I said, there's a lot of technicalities in this, but generally speaking, okay, you want us to make sure we're only talking to accredited investors. Are you going to require us to see financial statements? How intrusive do you want us to be to ensure we are only talking to people that meet these thresholds? And the response from the SEC was, look, we're not expecting you to do some kind of financial audit on these people's financial statements or information supplied, but there are reasonable and very not intrusive measures you can take. If, for example, you're working with an investment banking firm that houses the accounts of some of these individuals, well, then you've got a reasonable basis to believe that these individuals on this list are accredited. I think another area where I've seen quite a bit of that is given that a lot of advertising, if allowed, or outreach, if allowed, happens online, I've seen a lot of companies implement platforms where you have to go through a series of questions before you are able to get to the page where you would be able to access information about the company, or even go so far as to make an investment in the company. And I know the SEC has asked questions and asked to see different specifications for some of those sites. I guess that's just a couple examples. I mean, the SEC has the ability, because all of these transactions are under their jurisdiction, to ask questions, to ask for information. And a lot of the burden sits with the company and the other players involved in the capital raise to just make sure you're following the measures that are currently in place, because you never want to be the company that gets called out by the SEC and has to unwind a transaction. So we often say, as attorneys and others involved in the transactions, we're almost like the gatekeepers for these regulations, because again, on the very off chance, and I mean, there's who knows how many transactions happening a day, so it's a pretty low risk you're going to get called out by the SEC unless you're doing something just blatantly fraudulent or incorrect. But it does happen, and it keeps everybody on their toes, and including those in my practice area, because you never want to be on the wrong side of the SEC when you're a securities lawyer, ever. So the other big, those are really more private. I wouldn't say those are, private capital restrictions or pieces of legislation. I look at those two pieces, and specifically 506, as a pathway for private companies to access money that maybe wasn't previously available, that was previously only available to public companies. And even allowing public companies who maybe didn't want to jump through the hoops, like I said earlier, of doing a full registered offering, which is very expensive and very, consuming a lot of time, a lot of resources to access capital that they wouldn't have been available to them prior. As far as one of the other big pieces of the Jobs Act was making the path for a company to engage in an IPO simpler. I wouldn't say less. I mean, the information requirements, the disclosure requirements are still pretty extreme, especially for a company that hasn't put together some of those reports. But the Jobs Act created this category of company known as an emerging growth company that allows a company fitting those measures to not have to supply quite as much information. For example, only having to supply 2 years of audited financial statements as opposed to 3. Only have to provide executive compensation information for a lower number of individuals than would be required otherwise, and again for 2 years as opposed to 3, and just some other disclosure standards that made it a little bit of a simpler filing. It's still a pretty complex filing, but and then there are some other things with respect to when documents filed with SEC in connection with an IPO are available to the public, versus being able to submit filings to the SEC on a confidential basis, so you don't signal to the market you're about to do an IPO. But that's really more, I'm not sure that's within the parameters of the conversation or the stuff you guys are focused on.
What would be like a size range for an emerging growth company? Is there like a classification range?
There is. So it's a company that first has not sold any securities in the public market. It has not, essentially hasn't been a public company prior to the transaction they're about to engage, or about to undertake or engage in. And then at that point, you stay an emerging growth company until you have, oh goodness, I should know this off the top of my head. I want to say it's just over $1
billion.
I think, yeah, it's $1 billion in it's not assets, it's revenue, I believe, for your most recently completed fiscal year. Goodness, I should know that off the top of my head. I see the number all the time. I want to say it's 1.07 billion in revenue. But I can easily double check that though. But so there is a threshold. Once you cross that threshold, at that point, you're no longer considered an emerging growth company, and in your subsequent reports filed with the SEC, you have to then include that disclosure that you were allowed to leave out, and whether it's the additional year of audited financial statements. But the thought is you're going to be given a certain period of time to ease into that reporting standard or ease into the reporting system. And then, at that time you've been, and now as I say this, I think there's even a time frame associated with the emerging growth company standard. I want to say it's an either or, and I should probably just pull it up rather than me rambling. But I want to say it's the earlier of 2 years, latter of 2 years, or when you exceed this revenue threshold. So you at least get 2 years to not have to supply quite as much information, and your subsequent reports, whether it's your annual reports, your quarterly financial information that's filed, or and then once or you pass that revenue threshold. And in fact, I'm going to pull it up while we're talking about it, so I'm not not just speaking offhand.
So if what your company or your firm deals with is micro-cap public companies, are a lot of them currently, or have they been emerging growth companies? Have you been able to utilize this?
Yeah, I've got a handful of clients that are emerging growth companies, due in large part to the fact that they went public and did their IPO after the Jobs Act was implemented, and they have stayed emerging growth companies past that initial measurement period, because they just don't have the revenue to satisfy the test to exit that qualification. So yeah, and it's a huge. Well, no, I mean it's a pretty significant. What's the word I'm looking for? Something they definitely want to take advantage of, because as soon as you exit that system, you have a lot of not only having to supply additional disclosure about the company, but you have to engage in some other review of, say, your controls and your processes and procedures for putting together your financial statements. That you wouldn't have to otherwise. And there's just a number of things that just make it, the disclosure obligations for once you are no longer an emerging growth company, just much more burdensome. And so for companies that are emerging growth, they try to hang on to that as long as they can, because it's the regulatory scheme they've known, and two, it doesn't require them to undertake additional expense to, say, have their public auditing firm and reviewing and auditing their internal controls and processes and procedures for putting together their financial statements.
And I mean, you might not know the answer to this, and obviously you'd have to look at the nationwide thing to see if it's had an effect, but those companies who have had their IPO afterwards as emerging growth companies, do you think, from your perspective, that they chose to do an IPO earlier than they would have if the Jobs Act hadn't been implemented? or is it just like a happy coincidence that they were going to do an IPO and hey, we also have the advantage, or did it motivate their decision to go public?
I think the Jobs Act has influenced the decision by companies to engage in an IPO, maybe even a little bit earlier than they would have otherwise, not necessarily because of this qualification as emerging growth company, but something I briefly touched on earlier, which was the ability to submit your documents to the SEC confidentially. And then along with that is something that we call testing the waters marketing. I think that more than anything has been something that has caused companies to file earlier than they would have. But I think it's also caused a number of companies who have filed confidentially to not proceed with an IPO. And essentially that, to get into the details of this a little bit more, what this process allows you to do, it's known as a stealth filing or a draft filing or draft submission to the SEC. You're essentially able to put together the document you would otherwise file in connection with an IPO, known as an S1 registration statement, which under any other circumstance, once you file the S1 with the SEC, and the S1 is the document that contains all the information we're talking about: audited financials, executive compensation information, management's discussion of those financial statements, information about the company. So it's a sizable filing and it contains a lot of information. Before the Jobs Act, when you were ready to file that document, it was public immediately. It would be filed, and then as soon as filed, it would be available on Edgar, which I'm sure, given the context, I'm sure you guys, have you been on Edgar and just poked around public company filings?
You're not, Dayton? So you should. Britton and Griffin, are you familiar with Edgar?
I'm
No.
not, no.
Jessica, can you give a brief description
Sure.
of Edgar? Okay.
In fact, if you want to share screen, I can just walk you guys through.
Sure.
Show you Edgar
In fact,
briefly.
I've set it up so you can share
Okay, cool.
directly.
All right, let me just click over here. We will get to, okay. Okay, are you guys able to see? It should be the SEC's landing page.
Yes.
Okay, cool. So when you go to just sec.gov, this is what you find. Now on the SEC's website, you're able to find a bunch of information, but what we're looking for is company filings. And you'll see here, there's actually two places you can go to access company filings. This is probably the most helpful because it's kind of main, in the middle of the page. But some companies don't always pull up when you enter their information here. So if you come up to the top of the page, you'll see under the search box, you've got company filings, which I'll click on that so you can kind of see the it's not really the back doorway, but it's not that like central search feature on the main page. So when you click on that, it takes you to a screen that has some fields to input data. You can click this to see those additional options. But let's just take, we'll take Apple. So what this is going to take me to is the page where I can see all of Apple's SEC filings. Oh, and I should have known that we're going to get a bunch of Apple companies. Go to the Apple. So if I want to see, in fact, let's exclude. So you'll see these first filings that pulled up is what we call Form 4s. Those are ownership reports. That means that either directors or officers of Apple have recently probably been granted awards, equity-based awards, whether it's like stock options or restricted stock awards, something like that. But I'm going to exclude ownership reports so we can focus on the financial filings. But I mean, what's important is this takes you to everything that has been filed. All of the public reports have been filed with the SEC by Apple. So if I want to go in and take a look at Apple's most recent quarterly financials, I'm going to look for their 10Q, which is, excuse me, right here. All I have to do is click Documents. You want to, if you do this, look for the this first filing. You'll see some of these are exhibits to the 10Q filing, but just want to click on the very first one because it's usually your main document. And this takes me to Apple's most recent 10Q with, it looks like their first quarter results. Apple must have a funky fiscal year end. So the cool thing about Edgar is that you're able, I mean, anything filed with the SEC, setting aside what we were just talking about with IPOs, but anything filed with the SEC is immediately available on Edgar. So it is a wealth of information. If you're looking for filings, you know, a company's financial information, but also some filings that have signaled they've done capital raises. For example, if you engage in one of these Rule 506 offerings we were talking about earlier, a company is required to file what's called a Form D. And so if you're looking for some information about recent 506 offerings, a Form D is going to give you some information. Unfortunately, it's a pretty simple form, so you don't get a lot of information, but you at least are able to see, okay, this company engaged in an offering under Regulation D. And this is some very basic information about the offering. So, I mean, Edgar is just, I mean, you can find so much information on Edgar. So, and Edgar is an acronym. I believe it stands for Electronic Data Gathering and
Retrieval.
What is it?
Retrieval.
Retrieval. Thank you.
Yeah.
Yep. So, yeah, anytime you're looking for filings, I mean, Edgar is the first place I go. So let's just say, you know, a company has filed for an IPO before the Jobs Act. Their S1, as soon as they filed it with SEC, would appear on Edgar. So, and of course, news services and investment firms have, you know, settings so that they see as soon as a company files something. And so it's something that becomes very public very immediately. I'm going to go ahead and stop sharing my screen unless there's something else you want me to go over on Edgar. Okay.
So guys, you might remember me telling you that Alex Herman and I had put together a fair amount of data about a year ago. We did so through Edgar. So I'm going to, that data is currently stored on one of the Westminster drives. So I can only access it either through Westminster Anywhere or on campus. I will go ahead and pull those files into the OneDrive folder that I'm using to keep our items, and I'll share that folder with you. There's a lot. There's also a lot of other articles and such that that we had pulled that maybe I've already given you, maybe not, I don't recall.
So the piece, going back to the original question, which was, you know, what impact has this had on companies filing IPOs? What the Jobs Act has allowed is a company to initially submit their S1 to the SEC to review confidentially. So that is not available to the public. So there's not this spotlight on the company and these articles being published in the financial press about, hey, so-and-so has filed their IPO. Here's all this information. Here's their financials. Here's, and so it allows them to do so without all of the scrutiny or kind of pressure surrounding a public filing. But it also allows a company, since they have something on file with the SEC and have started the IPO process, to just begin to what we call test the waters and gauge interest in the IPO. So it allows them to, you know, file and then start talking to people and say, okay, is there really the interest we think is out there for an IPO, or are we better served to wait? And because all of those filings are confidential, unless they actually proceed to the point where they're going to pull the trigger on the IPO and move forward, at which point the filings do become public. It's difficult to know exactly how many companies have filed for an IPO with the SEC, but then decided not to for whatever reason. And I think that has been one of the biggest advantages and something that has caused more companies to think about going public than maybe would have otherwise, and maybe even stop companies from going public than maybe would have otherwise, if there just wasn't the investor interest when they did their initial outreach efforts in connection with the confidential filing.
So is there some data available to investors, or is it completely stealth, as you said?
Completely stealth. There you will find nothing online. The information that would be available to investors would come from the banking firm, and those testing the waters marketing, or testing the waters meetings. But even at that meeting, there's very little information made available. There's a lot of there's tight restrictions about what you can and cannot say during those meetings. Including in no way, shape, or form is anybody making an offer to buy securities. You can talk about things. Often investors participating, in fact, not often, always, investors participating in those meetings are under some kind of confidentiality agreement, have signed a non-disclosure agreement. The information is discussed, but nothing is given to the investor. It's the no leave behind rule that we call, that nothing is printed, they're not given any kind of even just a tear sheet. It's just all just verbal communication.
I was going to ask if you felt like that impacted investor sentiment regarding the company, but I guess those non-disclosures and kind of not being able to take anything with them, that kind of erases that problem.
Yeah, a little bit. I think the type of investor that's usually involved in those meetings is more. I think you're going to see more institutions involved in those meetings as opposed to individual investors or family offices. You may see family offices, but they're usually, you've got quite a large dollar value under management. They're typically investors that know the ropes. I would be surprised to see an investor that's involved in this type of offering for the first time involved in a testing the waters meetings. It's usually the guys that have been around the block a few times. So that's really what I thought about when this topic was brought up. But I know that there were a couple other things mentioned, so I guess I'll open up to you guys to ask questions of me. Anything else you want me to touch on? I know I talked. It's difficult because my practice largely focuses on public markets, and this concept of like I said earlier, that you're either under the federal securities laws, you're either engaged in a registered offering or one that's exempt from registration. And that really starts the thought process around an offering when we know whether we're going to be, proceeding down a path with a registered offering versus something that's exempt. But again, so I'll throw it out to you guys to see if you have any questions or anything else you want me to touch on.
One question I have relative to everything is, you mentioned at the beginning there's this push and pull between companies not wanting to share as much, especially small companies, and investors wanting more information. Have you noticed with the emerging growth companies and some of these small cap or micro IPOs, have you noticed any investor turnoff from the less burdensome information provided?
I don't know that I've noticed that in an IPO context or with emerging growth companies, because again, even under that disclosure system, the company is still expected to provide quite a bit of information. 2 years of audited financials gives not as wholesome picture into the company's financials as it might if it were a longer period, but it does give you an idea of where the company's been. It does give management an opportunity to include disclosure about where they're hoping to go. And it's a start. And I think investors in this space expect that. And I maybe there was some adjustment when this first went into place that investors weren't able to see a full 3 years of audited financials as would have been expected before the Jobs Act. But I think we're far enough away from it now that that's just kind of what people come to expect. Now, where we have seen that, and one area that you may have even read about as you've been doing research on the topic is Regulation A. And that is, and specifically something that was promulgated, I would say, or maybe a couple years ago, or 2 or 3 years from it, known as Regulation A+. Regulation A was another pathway or another exemption from the registration requirement that I talked about earlier. But given some of the hoops you had to jump through to use Regulation A, it wasn't utilized. A couple years ago now, the SEC promulgated rules to create almost a subset of Regulation A to make it much more useful to not only public companies, in fact, at the time it wasn't public companies, but to private companies. And what was really interesting about this was not only did it allow a company to reach, to do maybe a broader offering than what would be allowed under Regulation D, specifically because Regulation A doesn't have some of the restrictions around accredited versus non-accredited investors that Regulation D has. But it also created this pathway for a company to become a public company with a public market in their securities without having to go through the full registration process. Regulation A has a couple different tiers of offerings, and with each tier comes a different level of disclosure. I think of Regulation A because, and let me go back to the tiers. Tier 1, you're kind of very, I guess, entry-level Regulation A offering. You still have to provide a decent amount of information about the company, but not nearly what you would in a registration statement, where you could go all the way up to the highest level of the tiers, and you're essentially filing what would otherwise be a registration statement. So you're having to include all that audited financial information and the like. So, but it's kind of a variety of information. I think that's where we've seen the most push and pull between investors and companies. And in my mind, I don't know that especially those lower tier offerings in Regulation A have been quite as successful, or they've been quite as numerous as maybe some had thought when that regulation was first put into effect. I think because investors are just looking for more information. Especially in the current environment where markets have tightened up quite a bit, given everything that's going on right now. Investors are looking for safer places to park their cash, and a company that's fully transparent, well, at least as transparent as they have to be, maybe not fully transparent, but as transparent as they have to be under federal securities laws, is a safer place to be than this startup that's doing their seed round.
When Jessica refers to investors here, we have to think beyond investors like you and me. We have to think primarily into big institutional investors. People like ourselves aren't going to delve deeply into this if it's just for our own portfolio. But we're probably working with a broker. We've seen something we like. So she's talking about institutional investors. So kind of change some of your expectations to what that term might mean. Yeah,
that's a very good point. And one thing I like to say when you're starting to think about that is don't think about, like you said, you and me, think about some of these big funds that anybody in the space has probably heard of: Vanguard, BlackRock. CalPERS. I've had deals where they show up as an investor. So, and of course, those funds have just an unbelievable amount of money under management. So think about it in those terms, those kind of big investment houses, stepping in and acting as an investor in these offerings as a way to further manage the cash they have in their accounts.
So we've only got a few minutes left, and I apologize. I've got a 9 o'clock that's going to be fairly brittle. But before we go, Jessica, I think some of what you're telling us is that the Jobs Act specifically has made it easier for firms, less onerous for firms to go public.
Yes.
And that kind of flies in the face of some of our original hypotheses, which is not a problem. We just need to recognize that. Our hypotheses essentially is that we've seen a rebalancing, if you will, or an expansion in the private market activity and a corresponding reduction in public market activity as a function of availability of capital, rates of return, and regulatory changes. So are you able to argue, Jessica, that some of the regulatory changes we've seen have likely motivated that rebalancing or that shift in balance?
And shift in balance towards companies.
Towards private funding rather than public.
I don't know. I guess the best argument I could put forward would be that some of these regulatory changes have allowed companies to take just a peek at what a public market would look like for their securities and then make a decision as to whether or not they want to proceed. Now, that may have motivated a company to pull an IPO before they got too far down the road. It may have motivated a company to proceed with an IPO. But I think this ability to again, test the waters and just take a glance at what public markets might look like has been a pretty powerful tool. I do, however, think that we've seen a lot of companies go public in the last few years that maybe would not have otherwise because the capital markets were just, I mean, it was such a great time to tap the markets.
That's an availability of capital and rate of return issue.
Yeah,
right?
Absolutely.
Yeah.
Absolutely. I'll be very interested to see what happens in the next couple of years as things have almost, stopped. I mean, the markets have tightened up substantially. I think some of these other avenues for companies to raise money outside of the public markets, although maybe not utilized as much as may have been expected when these rules went into effect, maybe have also allowed a company to stay private longer than they would have otherwise. I mean, being a public company is a very expensive undertaking, and it's expensive to maintain. And I'm curious to know or to see again in the coming years when you don't have, this free flow of capital that I feel like we've had for the last couple of years, what impact that has. Now that's a little bit off of the question you raised, but it's difficult because I think I could argue either way. And also I'm biased. I more often than not see the public market side of things. I'm not involved in private offerings. I'm usually brought in when they're through their Series C or Series D round and getting ready to do an IPO, as opposed to the seed rounds or just the first time their company's taking the money from maybe angel investors. I do feel like though there's just been more activity, and I don't know if it's because I'm not quite sure what to attribute that to, but I feel like more money has flowed through angel and VC investors than we've seen in the past.
Without question.
Yeah.
Without question.
And I think maybe it is this ability to just take a peek at public markets and realize you want to stay private. I think investors are also starting to appreciate that maybe being a public company isn't this gold standard that it used to be seen as, and there's maybe some value to staying private.
And with that, we're going to have to end our meeting because I've got a Goldman Sachs meeting to jump into that's brittle. So Jessica, thank you.
Sure.
So I routinely record the Zoom sessions. Are you okay if I share the recording with these guys and even with yourself?
Oh, of course.
So they can go
Yes.
back. Okay, I thought so. I just wanted to get permission.
Yeah. And if there any other questions you guys may have, I mean, feel free to reach out to me. If you have another meeting where you'd like me to join, I'm more than happy to. I hope this was helpful. I feel like I was rambling for a bit of it, but I hope it was helpful.
Very happy. So guys, are we good to reconvene next Wednesday morning? And pick up? Okay. Well, Jessica, again, thank you very much. And I really do need to vanish here. So
Okay.
I will I'll talk to you all a little bit later. Thanks.
Thank you, Jessica.
Anytime. Take care, guys. Bye.